In 1933, President Franklin Roosevelt signed Executive Order 6102, making it illegal for American citizens to own gold. The official reason was to stabilize the banking system. The real reason was that Americans were demanding physical gold for their paper dollars faster than the government could deliver, exposing that far more paper claims existed than metal to back them. The order didn't prevent a crisis. It simply made the crisis illegal to participate in. Today, in late 2025, silver prices on the Shanghai Gold Exchange have surged to premiums exceeding 15% above COMEX futures prices, the largest sustained divergence between East and West silver markets in recorded history. Physical delivery delays on COMEX have stretched to over 60 days for some contracts, while Shanghai settles in physical metal within 48 hours. When the world's two largest silver markets price the same metal differently by double-digit percentages, while one struggles to deliver and the other settles instantly, what does that divergence reveal about which price reflects reality and which reflects illusion? For most of human history, price discovery in commodity markets was simple. Buyers and sellers met in physical locations, negotiated prices, and exchanged goods for money. The price reflected actual supply and demand because every transaction required physical transfer. If wheat was scarce in Alexandria, prices rose until buyers reduced consumption or sellers brought more supply. If silver was abundant in Potosi, prices fell until buyers increased usage or sellers reduced mining. This created a natural equilibrium. The key principle was that markets could not be separated by distance without prices converging. If silver traded at different prices in London and Amsterdam, merchants would buy in the cheaper market, ship the metal to the expensive market, and profit from the difference. This arbitrage activity would continue until prices equalized, minus the cost of transportation and insurance. Geography could create temporary price differences, but not sustained divergences of more than a few percentage points. The Spanish Empire in the 16th and 17th centuries operated on this principle. Silver mined in the Americas, primarily from Potosi in modern-day Bolivia and Zacatecas in Mexico, was shipped across the Atlantic to Seville, then distributed throughout Europe. From Europe, much of it continued eastward to Asia, particularly China, where demand for silver was insatiable due to China's silver-based monetary system. The entire trade network functioned because silver prices, adjusted for transportation costs, remained relatively aligned across continents. If silver in China commanded a significantly higher price than in Europe, merchants would ship more silver eastward. The increased supply in China would lower prices there, while reduced supply in Europe would raise prices until the arbitrage opportunity disappeared. This self-correcting mechanism ensured that physical commodity markets remained integrated despite the months required for ships to cross oceans. The critical insight is that this price convergence depended on the physical movement of goods. Arbitrage was not merely theoretical. Traders actually had to buy silver in one location, transport it across dangerous seas or hostile territories, and sell it in another location. The friction of physical movement limited how quickly prices could converge, but the profit motive ensured they eventually did. China's role in the global silver market during this period cannot be overstated. The Ming and Qing dynasties operated on a silver standard for nearly 500 years, from the 15th century through the 19th century. Unlike European nations that used both gold and silver in bimetallic systems, China demanded silver exclusively for trade. This created structural demand that absorbed enormous quantities of metal from global production. Estimates suggest that between 1500 and 1800, approximately half of all silver mined in the Americas eventually flowed to China through trade. European merchants purchasing Chinese silk, porcelain, tea, and spices paid in silver because China produced goods Europe wanted, but demanded payment in a form China valued. This trade imbalance drained European silver reserves and created the impetus for European nations to develop their own manufacturing capabilities to reduce dependence on Chinese imports. The important lesson from this period is that markets separated by vast distances still functioned as a unified system because physical delivery was both possible and enforced. A merchant selling silver in Canton had to deliver actual metal. A buyer in Amsterdam purchasing silver from a Spanish trader received physical bars or coins. Promises to deliver were backed by law, reputation, and the threat of commercial ruin for those who failed to honor contracts. The system was not perfect. Shipwrecks, piracy, and fraud occurred, but the fundamental expectation was that transactions involved physical exchange. The London Metal Exchange, established in 1877, formalized this principle for industrial metals including silver. Traders could buy or sell contracts for future delivery, but the contracts were ultimately backed by physical metal stored in approved warehouses. The LME's credibility depended on its ability to deliver metal against contracts. If a buyer demanded delivery and the exchange could not provide it, the exchange's reputation would be destroyed and trading would cease. This enforcement mechanism kept paper prices tethered to physical reality. The concept of arbitrage, buying in one market and selling in another to profit from price differences, only works if both markets are physical or if paper markets are strictly constrained by physical delivery. In a purely physical market, arbitrage requires actual movement of goods, which costs money and takes time but is ultimately feasible. In a paper market backed by physical delivery, arbitrage requires the ability to take or make delivery, which again connects the paper price to physical reality. The breakdown of this system began when markets introduced paper contracts that could be settled in cash rather than physical delivery. Once participants could trade silver without ever intending to receive or deliver metal, the connection between paper prices and physical supply began to weaken. And once that connection weakened, the possibility emerged that paper and physical markets could diverge not by small percentages reflecting transportation costs, but by substantial margins, reflecting entirely different supply and demand dynamics. The modern structure of global silver markets was not designed to enable price manipulation or disconnect paper from physical. It evolved through a series of decisions intended to increase liquidity, reduce volatility, and allow hedging without physical transfer. But the cumulative effect of these decisions created a system fundamentally different from anything that existed historically. The COMEX, the primary silver futures exchange in the United States, was formed in 1933 through the merger of several commodity exchanges. Silver futures trading existed before this, but COMEX standardized contracts and established warehousing and delivery procedures that became the global benchmark. For decades, COMEX functioned as a physical market. Most contracts were settled through delivery. Warehouse inventories were substantial. Prices reflected actual supply and demand for physical metal. This began changing in the 1970s and accelerated in the 1980s following the Hunt brothers' attempt to corner the silver market. The Hunts accumulated an estimated 100 million ounces of physical silver and held substantial long positions in futures contracts. Their strategy drove silver prices from under $6 per ounce in 1979 to over $50 in January 1980. The surge threatened the solvency of traders who had sold silver short, assuming prices would remain stable. COMEX responded by changing the rules mid-game. In January 1980, the exchange implemented regulations limiting new long positions and forcing liquidation-only trading. Margin requirements were increased dramatically. The combined effect was to collapse silver prices. By March 1980, silver had fallen below $11 per ounce. The Hunts were financially ruined, and the lesson absorbed by the market was that concentrated physical buying could be defeated through exchange rule changes. But the deeper lesson, less widely understood, was that COMEX had revealed a preference for price stability over physical delivery. The exchange altered rules not to facilitate delivery, but to prevent it. Traders who had sold silver they did not possess were protected by regulations that prevented buyers from demanding delivery. This established a precedent. When physical delivery threatens the paper market's rules will be changed to protect paper sellers. Following the Hunt episode, COMEX trading increasingly shifted toward cash settlement. Most participants, hedge funds, banks, commodity trading advisors, had no interest in physical silver. They traded futures to speculate on price movements or hedge other positions. Settling in cash was simpler than taking delivery of metal, arranging storage, and eventually selling it. As cash settlement became the norm, the connection between futures prices and physical availability weakened. By the 1990s and 2000s, estimates suggested that paper silver claims exceeded physical silver available for delivery by ratios of 10.1, 51, or even 100.1. The exact ratio is unknowable because over-the-counter derivatives, bank positions, and unallocated accounts are not publicly disclosed. But the direction was clear. Far more silver was being traded on paper than existed in deliverable form. This structure was not unique to silver. Gold, copper, oil, and agricultural commodities all developed similar paper-to-physical ratios as futures markets grew. But silver was particularly vulnerable because its relatively small market size, total annual production of approximately 1 billion ounces worth roughly $25 billion at current prices, made it possible for large financial players to dominate paper trading, with positions far exceeding physical availability. The Shanghai Gold Exchange, SGE, established in 2002, developed under a fundamentally different philosophy. Chinese regulatory authorities, having observed Western financial crises and market manipulations, designed SGE as a physical settlement-only market. Participants could trade spot contracts and forward contracts, but all contracts required physical delivery within 2 business days. Cash settlement was not permitted. This meant that anyone selling silver on SGE had to deliver actual metal, and anyone buying silver would receive physical bars. This design reflected China's historical experience with paper currency and commodity markets. The Song dynasty. His experiment with paper money in the 11th century had ended in hyperinflation when issuance exceeded backing. The Qing dynasty's struggles with foreign traders and opium had involved manipulation of silver flows and prices. Modern Chinese policymakers understood that allowing paper claims to vastly exceed physical backing created manipulation opportunities and systemic risks. For years, the structural difference between COMEX and SGE was irrelevant to global price discovery. COMEX, with far greater trading volume and international participation, set the global price. SGE prices tracked COMEX with minor premiums, or discounts reflecting local supply conditions and import-export restrictions. Arbitrage between the two markets was limited by Chinese capital controls and import quotas, but when SGE premiums or discounts became large enough, physical metal would flow to equilibrate prices. The key mechanism was the import-export channel. When SGE prices rose above COMEX by more than the cost of importing, shipping insurance, import duties, traders would buy silver on COMEX, or from mines and refiners delivering into COMEX, ship it to China and sell it on SGE for a profit. This physical arbitrage kept SGE premiums within a 2 to 4% range under normal conditions. Conversely, if COMEX premiums were higher, Chinese traders could export silver to the West, though this was rarer due to China's policy preference for retaining physical metal domestically. But this arbitrage mechanism depended on the ability to source physical metal from COMEX at quoted prices and deliver it promptly. If COMEX could not deliver physical metal, either because inventories were depleted or because delivery was delayed or restricted, then the arbitrage broke down. SGE prices could rise above COMEX indefinitely because there was no physical flow to equilibrate them. This is the situation that began emerging in late 2024 and has accelerated through 2025. SGE premiums over COMEX, which historically averaged 2 to 3%, began rising to 5%, then 8%, then exceeding 10% by mid-2025. As of late 2025, premiums have reached 15% and occasionally spiked higher. At the same time, reports began circulating of COMEX delivery delays stretching from the standard 3 to 5 days to 30, 45, and in some cases over 60 days. These delays are not being officially announced by COMEX. They appear in anecdotal reports from traders, refiners, and industrial users who have demanded delivery and experienced extended waits. COMEX's official position is that all contracts are being fulfilled according to the rules, but rules now include provisions, allowing delayed delivery under certain conditions. The exchange has not declared force majeure or default, but the practical reality is that immediate physical delivery, the mechanism that kept paper markets honest, is no longer reliably available. Meanwhile, Shanghai continues to settle within 48 hours. Chinese traders demanding delivery receive metal. This creates a stark divergence. In the West, silver is priced based on paper trading, where delivery is uncertain. In the East, silver is priced based on physical availability, where delivery is immediate. And increasingly, the physical market is pricing silver substantially higher than the paper market. The quantifiable evidence of this divergence is visible in exchange data, inventory levels, and price spreads that have no modern precedent. COMEX registered silver inventories, metal available for immediate delivery, stood at approximately 350 million ounces in early 2020. By late 2025, registered inventories have fallen to under 35 million ounces. This represents a 90% drawdown in less than 6 years. Total COMEX inventories, including eligible silver that is not warranted for delivery, have fallen from over 400 million ounces to approximately 240 million ounces. The 35 million ounces currently registered represents less than 2% of annual global silver production and less than 2 days of global industrial demand. More critically, it represents less than 20% of open interest in COMEX silver futures, with open interest exceeding 170,000 contracts, each representing 5,000 ounces. Total claims on COMEX silver exceed 850 million ounces. The ratio of paper claims to deliverable metal has reached 24.1. Shanghai Gold Exchange data shows a very different picture. Physical inventories held in SGE-approved vaults have increased from approximately 2,500 metric tons, 80 million ounces, in 2020 to over 4,000 metric tons, 128 million ounces, as of late 2025. This is not because China is producing more silver. Chinese mine production has remained relatively stable at approximately 3,500 metric tons annually. The increase represents imports of physical silver from global sources, including drawdowns from COMEX and London vaults. The price spread between SGE and COMEX has widened from an average of 2.3% between 2015 and 2023 to a current level exceeding 15%. This means that silver trading at 24 per ounce on COMEX is simultaneously trading at over 27.50 per ounce on SGE. In absolute terms, the premium is approximately $3.50 per ounce, larger than the entire transportation, insurance, and import duty costs for shipping silver to China. Under normal arbitrage conditions, this $3.50 premium should trigger massive physical flows from west to east. Traders should be buying silver on COMEX, shipping it to Shanghai, and selling it for guaranteed profit. The fact that the premium persists and is widening rather than narrowing suggests that this arbitrage is not occurring at sufficient scale, either because COMEX cannot deliver metal in required quantities or because traders doubt their ability to source physical silver at COMEX quoted prices. Delivery data supports this interpretation. In 2020, COMEX silver deliveries averaged approximately 30 million ounces annually across all contract months. In 2023, deliveries increased to over 80 million ounces. In 2024, deliveries exceeded 120 million ounces, more than triple the 2020 level. And in 2025 through November, deliveries have already exceeded 150 million ounces, with December still pending. This surge in delivery demands is draining registered inventories faster than they can be replenished. Silver must be sourced from mines, recyclers, or conversions from eligible to registered status. But mine production is relatively fixed. Global production is approximately 830 million ounces annually and cannot be rapidly increased. Recycling provides approximately 170 million ounces annually, but is limited by available scrap. Converting eligible to registered requires vault owners to voluntarily warrant their metal for delivery, which they will only do if compensated adequately. The Shanghai premium is the market's signal that compensation is inadequate. If COMEX prices reflected true physical scarcity, registered inventories should be increasing as higher prices incentivize vault owners to convert eligible metal and refiners to deliver new production into COMEX. Instead, inventories continue declining, suggesting that COMEX prices are too low to attract physical supply even as delivery demands intensify. Import data shows the physical flow pattern. China imported approximately 4,800 metric tons of silver in 2023, the highest level in 5 years. In 2024, imports increased to over 5,500 metric tons. Preliminary data for 2025 suggests imports could exceed 6,000 metric tons. These imports are sourced primarily from London vaults, Perth Mint, and indirectly from COMEX through refiners and traders who take delivery and re-export. London silver market data shows corresponding inventory drawdowns. London vaults, which held over 35,000 metric tons of silver in early 2020, have declined to approximately 28,000 metric tons as of late 2025. This 7,000 metric ton reduction, 225 million ounces, over 5 years represents physical metal flowing from west to east to satisfy Chinese demand at premium prices. The key question is why arbitrage has not equilibrated prices. Why doesn't the Shanghai premium incentivize enough physical flow to close the gap? The answer appears to be that Western holders of physical silver, whether in COMEX warehouses, London vaults, or ETF holdings, are increasingly reluctant to sell at current prices because they anticipate higher prices in the future, or because they view physical silver as insurance against currency debasement and financial instability. Exchange-traded funds provide evidence of this reluctance. The iShares Silver Trust, SLV, the largest silver ETF, held approximately 550 million ounces in early 2021 following the Reddit-driven buying surge. Holdings declined through 2022 and 2023 as investors sold. But since mid-2024, holdings have stabilized near 450 million ounces and begun increasing slightly despite silver prices remaining well below 2021 peaks. This suggests that at current prices, investors are net buyers, or holders rather than sellers. Industrial demand data shows continued strength. Solar panel production, which consumed approximately 200 million ounces of silver in 2024, is projected to consume 240 million ounces in 2025. And could reach 300 million ounces by 2027 if current growth rates in solar installations continue. Electric vehicle production, which used approximately 60 million ounces in 2024, is projected to reach 85 million ounces in 2025. Total industrial silver demand for 2025 is estimated at over 850 million ounces, exceeding mine production by approximately 20 million ounces. This deficit must be filled by above-ground inventories, recycling, or demand destruction through higher prices. Recycling is relatively inelastic in the short term. Demand destruction requires prices high enough that industrial users either reduce production or invest in substitution technologies. And above-ground inventories are finite and depleting. The drawdowns in COMEX, London, and ETF holdings are the physical manifestation of this deficit. The mathematical reality is straightforward. If industrial demand exceeds mine production by 20 to 40 million ounces annually, and investment demand adds another 100 to 200 million ounces in years when confidence in financial assets is weak, then 120 to 240 million ounces must come from inventories annually. At that rate, visible inventories, COMEX, London, ETFs, will be depleted within 3 to 5 years, unless prices rise enough to incentivize recycling, reduce demand, or stimulate new mine production. But mine production cannot increase quickly. Lead times for new mines are 5 to 10 years from discovery to production. And because 70% of silver is mined as a byproduct of copper, lead, and zinc operations, silver production is largely determined by demand for base metals rather than silver prices. Even if silver prices doubled, total production might increase only 10 to 15% over several years. This creates a fundamental mismatch: structural demand growth driven by solar and EV production that cannot be deferred, meeting supply that is largely inelastic to price, while inventories that historically buffered the deficit are approaching depletion. The Shanghai Premium is the market's early warning signal that this mismatch is becoming acute. Chinese buyers, operating in a physical-only market, are bidding prices higher to secure supply. Western paper markets, where cash settlement allows supply to be created through contract issuance, are suppressing prices below physical clearing levels. The divergence cannot persist indefinitely. The Shanghai COMEX price divergence is not occurring in isolation. It is accompanied by signals across commodity markets, currency systems, and trade flows that suggest a broader fragmentation of global markets and a shift from paper-based price discovery to physical-based pricing. The first signal is the behavior of the gold-silver ratio in Shanghai versus COMEX. Historically, the gold-silver ratio, ounces of silver required to buy 1 ounce of gold, has been relatively consistent across markets. Arbitrage ensures that if gold and silver prices diverge between exchanges, traders will buy the underpriced metal in one market and sell it in the other until ratios realign. On COMEX, the gold-silver ratio has remained elevated near 85.1 through most of 2025, despite silver inventories falling dramatically. This suggests the paper market is not pricing silver scarcity. On Shanghai, the effective gold-silver ratio, calculated using SGE spot prices, has fallen to approximately 72.1, significantly lower than COMEX. This 13-point difference in the ratio is unprecedented in modern markets and indicates that Shanghai is pricing silver relative to gold as being more scarce than COMEX suggests. If the ratio on both exchanges were pricing the same physical reality, they should be nearly identical. The divergence indicates they are pricing different markets. COMEX is pricing a paper market where silver supply can be expanded through contract issuance. Shanghai is pricing a physical market where silver supply is constrained by available metal. The second signal appears in silver lease rates and forward premiums. Silver lease rates, the cost of borrowing physical silver for future delivery, have risen sharply in London and New York markets since early 2024. Rates that were typically 0.5 to 1.5% annually have spiked to 4 to 7% for short-term leases and exceeded 10% during periods of acute demand. Elevated lease rates signal that holders of physical silver are reluctant to lend it, either because they fear it will not be returned, or because they anticipate higher prices in the future and don't want to miss gains. Banks and bullion dealers that previously lent silver readily to earn small returns are now either refusing to lend or demanding much higher compensation. This hoarding behavior is consistent with expectations of physical shortages. Forward premiums, the difference between spot prices and prices for delivery in future months, show similar stress. Under normal conditions, forward prices are slightly higher than spot prices by an amount equal to the cost of financing and storage, contango. But in periods of physical shortage, spot prices can exceed forward prices, backwardation, as buyers prioritize immediate delivery over future promises. Silver markets have shown intermittent backwardation since mid-2024, particularly in Shanghai, where physical delivery is enforced. COMEX has remained in contango, but the contango has narrowed significantly, suggesting that even in the paper market, concerns about future supply availability are emerging. The third signal is visible in the behavior of silver mining companies and their production decisions. Under normal market conditions, mining companies hedge future production by selling forward contracts to lock in prices and reduce risk. This is prudent risk management that allows mines to secure financing and operate with predictable cash flows. But since 2024, many silver mining companies have reduced or eliminated forward selling. They are choosing to remain unhedged, exposed to price fluctuations, rather than lock in current prices. This behavior suggests that miners, who have better information about supply conditions and production costs than most market participants, believe current prices significantly undervalue silver and expect substantially higher prices in the future. Public statements from mining executives support this interpretation. Multiple companies have noted difficulties in securing supplies of chemicals, equipment, and skilled labor necessary to expand production. Some have delayed or canceled expansion projects, despite silver prices being at multi-year highs, citing uncertainty about whether prices will remain high enough to justify the investment. This cautious behavior contrasts with typical mining industry practice of aggressively expanding during price booms. The reluctance to expand production despite higher prices is itself a signal. It suggests that miners do not believe current price levels are sustainable, not because they will fall, but because they will rise. If miners believed $24 silver represented a permanent new price floor, they would invest heavily in expansion. Their hesitation suggests they are waiting for a higher price confirmation before committing capital, or that they face physical constraints that prevent expansion regardless of price. The fourth signal appears in currency markets and trade flows. China's yuan has been under persistent depreciation pressure against the dollar since 2022, falling from approximately 6.3 yuan per dollar to over 7.2 yuan per dollar by late 2025. Under normal conditions, a weaker yuan should make Chinese exports more competitive and imports more expensive, reducing China's demand for imported commodities like silver. But silver imports into China have increased despite the weaker yuan. This suggests that Chinese demand for physical silver is driven by factors other than price competitiveness, possibly by a strategic decision to accumulate real assets as insurance against currency instability, or by genuine industrial demand growth that is not price sensitive in the short term. Chinese central bank behavior supports the strategic accumulation interpretation. The People's Bank of China has been a consistent buyer of gold since 2022, adding over 400 metric tons to official reserves. While the PBOC does not report silver holdings, the pattern of physical precious metals accumulation suggests a broader policy of diversifying reserves away from dollar-denominated financial assets into tangible commodities. The fifth signal is the increasing frequency of delivery failures and disputes in commodity markets beyond silver. Nickel markets experienced a historic short squeeze in March 2022 when the London Metal Exchange was forced to cancel trades after prices spiked 250% in 2 days due to a combination of Russian supply concerns and concentrated short positions that could not deliver metal. The LME's decision to void trades, effectively protecting short sellers who faced unlimited losses, undermined confidence in commodity futures markets as reliable price discovery mechanisms. Aluminum, copper, and zinc markets have all experienced unusual pricing dynamics, delivery delays, and inventory drawdowns since 2022. These are not isolated incidents. They reflect a broader pattern where paper commodity markets are struggling to maintain credibility in the face of physical supply constraints and geopolitical fragmentation of trade flows. The pattern across all these signals is consistent. Markets are fragmenting into physical and paper segments that are pricing assets differently. In physical markets where delivery is enforced, Shanghai, spot bullion dealers, industrial supply contracts, prices are rising to reflect scarcity. In paper markets where cash settlement is the norm, COMEX futures, over-the-counter derivatives, unallocated accounts, prices remain suppressed because supply can be created through contract issuance without requiring physical metal. This fragmentation is unsustainable. Eventually, participants in paper markets will demand delivery or shift to physical markets, forcing repricing, or exchanges will be forced to declare force majeure and settle contracts in cash, destroying confidence in futures markets, or physical supply will somehow increase dramatically, relieving scarcity and closing the price gap. Historical precedent suggests the first two outcomes are far more likely than the third. History provides clear guidance on what happens when paper claims on physical commodities vastly exceed available supply, and two markets price the same commodity at substantially different levels while one can deliver and the other cannot. The most direct precedent is the London gold pool collapse in 1968. From 1961 to 1968, the United States and 7 European central banks operated a gold pool to maintain the London gold price at $35 per ounce, the official Bretton Woods price. The pool sold gold into the market whenever demand threatened to push prices higher, and bought gold when prices weakened. This worked as long as the pool's gold reserves were adequate relative to demand. But by 1967, demand for physical gold was overwhelming the pool's ability to supply. In March 1968, the pool sold over 1,000 metric tons, nearly 40% of annual mine production, in a single month trying to defend the $35 per dollar price. On March 17, 1968, the pool collapsed. The gold market was closed, and when it reopened, a two-tier system was established. Official transactions between governments remained at $35 per ounce, but private market transactions were allowed to float. Within 2 years, private gold prices had risen above $40 per ounce. By 1971, the entire system collapsed when Nixon closed the gold window. By 1980, gold had reached $850 per ounce, 24 times the official price that the pool had tried to defend. The lesson is clear. When physical demand exceeds available supply and one price is being defended through sales of reserves, the defense eventually fails, and repricing is violent. The Shanghai COMEX divergence follows a similar pattern. COMEX is effectively defending a price ceiling by allowing unlimited paper contracts to be issued. Shanghai is allowing physical supply and demand to determine prices. COMEX can maintain its pricing as long as most participants settle in cash and don't demand delivery. But the 90% drawdown in registered inventories and the 60-day delivery delays suggest that the defense is failing. Participants are increasingly demanding physical metal, and COMEX is struggling to supply it. If this pattern continues, several outcomes are possible, none of them orderly. The first possibility is COMEX default through force majeure declaration. If delivery demands exceed available inventories and metal cannot be sourced at prevailing prices, the exchange could invoke force majeure provisions and settle contracts in cash at prices that do not reflect physical market values. This would destroy confidence in COMEX as a price discovery mechanism and likely trigger a rush to Shanghai and other physical markets, driving prices sharply higher. The second possibility is rule changes similar to the Hunt Brothers episode. COMEX could increase margin requirements dramatically, limit position sizes, or restrict trading to liquidation only. This would force leveraged longs to sell, temporarily suppressing prices. But unlike 1980, when the Hunt brothers were a concentrated target, current delivery demands appear to be coming from industrial users, Chinese buyers, and diversified investors, a much broader base that cannot be easily targeted through rule changes. The third possibility is that COMEX prices rise sharply to incentivize physical supply, either through conversions of eligible to registered inventories or through reduced industrial demand at higher prices. This repricing would close the Shanghai premium as prices converged at higher levels. But it would also validate Shanghai pricing and confirm that COMEX had been suppressing prices below physical market clearing levels. The fourth possibility is intervention by governments or central banks. If silver shortages threaten industrial production, particularly in strategic sectors like defense electronics, aerospace, and renewable energy, governments could release strategic stockpiles, impose export restrictions, or pressure mining companies to increase production. The United States no longer holds significant silver stockpiles, having sold most government reserves decades ago. China, as the largest producer and consumer, could restrict exports, exacerbating shortages in Western markets. Each of these outcomes carries broader implications beyond silver prices. A COMEX default would undermine confidence in all commodity futures markets. If silver contracts are not honored, why would participants trust gold, copper, or oil contracts? The $50 trillion global derivatives market depends on the credibility of exchange settlement. Failure in one major commodity market could trigger contagion. For industrial users, particularly in solar and electronics sectors, a silver supply crisis would force immediate responses. Production might need to be reduced if metal cannot be sourced at any price. Alternative materials like copper could be substituted in some applications, but substitution requires engineering redesign that takes months or years. In the short term, users would be forced to pay Shanghai prices plus premiums to secure supply, sharply increasing input costs. For investors, a Shanghai COMEX divergence that widens rather than closes would validate the thesis that physical possession of hard assets is necessary during periods of financial system stress. Paper claims, whether futures contracts, unallocated accounts, or even some ETFs, could be settled in cash at prices far below physical market values, transferring wealth from paper holders to those who demanded physical delivery before the crisis became acute. The geopolitical implications are profound. If China controls physical supply through production and accumulation, while Western markets trade paper claims, China effectively controls pricing for a commodity essential to the energy transition. Solar panel production depends on silver. If Western nations are forced to buy silver at Shanghai prices plus premiums while China allocates domestic production to domestic users at preferential rates, it creates strategic dependence similar to Europe's previous dependence on Russian natural gas. Historical precedent suggests that when paper and physical markets diverge significantly and persistently, repricing occurs through crisis rather than gradual adjustment. The gold pool collapse was sudden. Defenders sold over 1,000 tons in a month, then abandoned the defense entirely within days. The Hunt brothers' silver squeeze saw prices rise from $6 to $50 in 18 months, then collapse to $11 in weeks. The 2011 silver rally went from $14 to $49 in 2 years, then fell 30% in 5 days. What all these precedents share is that the transition from one pricing regime to another is nonlinear and volatile. Prices do not adjust smoothly from paper-based to physical-based levels. They spike, crash, and eventually settle at levels that reflect physical supply and demand after the paper market mechanisms have been discredited or destroyed. The current Shanghai premium is a signal that this transition is beginning. The premium has existed and widened for over a year, far longer than historical arbitrage opportunities typically persist. The delivery delays on COMEX are lengthening rather than shortening. Inventories are falling rather than rising. And Shanghai continues to settle physically, while COMEX increasingly relies on cash settlement and delays. In 1933, the Roosevelt administration made it illegal to demand gold for paper dollars because too many Americans were doing exactly that, exposing that more claims existed than metal to back them. The response was not to honor the claims. It was to criminalize the demand. 70 years later, in 2008, AIG nearly collapsed because it had sold more credit default swap insurance than it could possibly honor. The response was not to allow default, it was to bail out the claimants with taxpayer money. The pattern is consistent. When paper claims vastly exceed physical backing or financial capacity, authorities intervene to protect the paper system rather than enforce delivery. This works as long as participants accept the intervention. It fails when participants demand physical settlement regardless of official positions. Shanghai silver rising 15% above COMEX, while COMEX delivery delays stretch beyond 60 days, is not a temporary arbitrage opportunity. It is evidence that two different markets are pricing the same commodity based on fundamentally different supply conditions. One market allows unlimited paper claims and settles primarily in cash. The other requires physical delivery within 48 hours and settles exclusively in metal. The divergence cannot persist indefinitely through arbitrage, because arbitrage requires the ability to source physical metal from the lower-priced market and deliver it to the higher-priced market. If the lower-priced market cannot deliver, either because inventories are depleted or because delivery is delayed or restricted, then arbitrage fails and the divergence widens. This is not speculation about future events. This is observation of current conditions. COMEX registered inventories have fallen 90%. Shanghai premiums have risen from 2% to 15%. Delivery times have extended from days to months. These are measurable facts, not predictions. The question is not whether these conditions are sustainable. Clearly, they are not. 90% inventory drawdowns and 15% sustained price divergences between markets that should be arbitrage-linked are unprecedented and unstable. The question is how the instability resolves. Through COMEX repricing upward to Shanghai levels, through Shanghai premium collapse if Chinese demand weakens, or through COMEX default if delivery demands exceed available supply. History suggests which outcome is most likely. When paper claims vastly exceed physical backing and participants begin demanding delivery, the paper system breaks. It does not smoothly adjust. It reprices violently or defaults. Silver markets are approaching that point, not next week or next month necessarily, but within a time frame where the trajectory is established and the mathematics are undeniable. Shanghai is pricing physical reality. COMEX is pricing paper promises. And the gap between reality and promises is widening, not closing. That is not a prediction. That is a pattern. And patterns, when they reach this stage, do not reverse peacefully.